about a month ago, I started saying that I was buying. If you looked at how sentiment had played out, it really felt like we'd hit a bottom, at least an interim bottom, and risk was relatively low that we could see further downside. These are hard assets that are not printable. What's been money for 5,000 years? I can't see a better alternative, frankly, and a better hedge. People need exposure, even if it's relatively small. This is an essential. I get moving on it. That's all I can say. If you don't have any yet, actual inflation, people feel it. We all know better. It's a lot higher than what official numbers are, and these will remain strong tailwinds for precious metals.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance, and back with us today is our good friend Peter Krauth from silverstockinvestor.com. Peter, thank you so much for joining us today.
Elijah, as always, pleasure to be here with you.
Well, it's great to have you. I remember our first talk, we were talking about your book, The Great Silver Bull, and that's when silver, I think, was around $20 an ounce. So we've come a long way with you. I did want to ask you about where are we right now, because over the last couple of weeks, we've seen silver increase about $10 or so from its lows, probably actually more than $10, up to the $66 level. Today, we're seeing about $65 as we record this on Thursday, August 13th. But your take where we are right now, a lot of people in the space are looking at this technically and saying, silver might be breaking out here. Do you see this as just kind of, we're still range bound, or that silver could actually be making a big move right now?
Thank you. Elijah, the first thing I do want to say is that it's amazing to me to see how you're right. Some people are saying, we could have a breakout here, or are we going to consolidate more? But interestingly is that you still have a lot of people who are just crying about silver prices, and yet you pointed out that when we started talking about 4 years ago, silver was at $20 and now we're at $65, and they're still complaining about the silver price. I can tell you that most mining company executives are not complaining about the silver price. They can make plenty of profit at these levels, and just a year ago we were at somewhere around 37. So we're about 80% above where we were a year ago. This is just fantastic levels, and people are just have short memories. They look back to January and they see silver at 110 or 120, and they think, "Oh my goodness, it's all over." But to your question specifically, I think that my view is that there are, it's all about probabilities. I think probabilities are good that we do have the start of a new bull, or at least a new cycle. I do want to temper that, though, by saying that right now, and this is what I told my subscribers just this week, that if you look at the gold and the silver charts, both metals are still actually below their 200-day moving average. So I'm not a big technical analyst, but I do know that when the price is above the 200-day, then there is, I guess you'd say, more comfort and more certainty that we are now in a new sort of upward cycle. So for that reason, at least on the technical side, I'm a little bit cautious. Although that also being said, about a month ago, I started saying that I was buying. And I felt that, if you looked at how sentiment had played out, that it really felt like we'd hit a bottom, at least an interim bottom, and odds were low. Risk was relatively low that we could see further downside. It seemed like my sense was that it made good economic sense to start adding to positions or even initiating new positions. That we had basically gone through a really pretty significant correction from where we had been at the end of January, and it was a good risk reward setup at that point in time. Now, like I say, we've certainly seen gold, silver, the stocks move significantly since then. Some have less than others. Some have either not moved at all. Some may even have moved down a little bit. But on balance, they've done relatively well. I still think that there is some risk of perhaps another maybe final pullback, a test. But I think that the overall odds, if I had to say probabilities, I'd probably say somewhere around 60-65% probability that we've started a new upward cycle. Those lows, if we look at silver, which is around $55 you mentioned earlier, that essentially looked like it was testing the previous ceiling, which we set in October, November of last year. So technically, it looks like what we've done is we've just tested what was previously overhead resistance, and that may have now become a support level. So I think that buying at these levels is probably pretty good bet. I would say just don't go all in at this point. Buy in gradually.
It is quite interesting how it seems like markets tend to do that. It kind of retests that level, though. It's so important before the $54 level. I remember, I guess it puts things in perspective, because last year we had 54 as the high, and then we went all the way back to like 45, and everyone was saying, oh, it's over, and then we went to 120. So it's crazy how that just looks like a blip on the chart now, you know? But that was a couple weeks of a lot of pain for silver investors and a lot of worry. But now it just seems, it seems kind of silly to even worry about that time.
Exactly. You know, I mean, if you understand this market, then it takes some conviction, and then it takes tenacity. And I say that because you're going to get, and especially in silver, you're going to get these tests, these retests, and it plays with you as an investor. So, like I say, you have to have patience and you have to have conviction. If you really do understand the deeper inner workings of the silver market and why we're in a secular bull, which in my view still has probably 5 to 10 years, maybe even beyond that. We can get into that another time. It's almost a little bit more sort of philosophical, I guess, but I do think that there are many, many good years left. Volatility will always be there. If you have the conviction because you understand the market, then you're willing to sit tight and you take advantage of pullbacks like we've just witnessed from 120 to 55, which is more than 50%. To take it to use that to your advantage and to either initiate if you have not yet participated or build on positions where you feel you don't have enough exposure.
Right now, we're offering silver Morgan or Peace dollars in a Cull grade at one of the lowest premiums we've ever seen. Call us at 1-888-815-4237 for details on this rare, low-premium opportunity to stack one of the most sought-after coins in the U.S.
Certainly, I would like to get to some of those macro factors that make you say that we could have 5 to 10 years down the road or even more in this bull market. One of the things that people have highlighted recently is the strength of the U.S. dollar. It's almost... it seems like the mask has been taken off a little bit as we've seen the U.S. Treasury intervene in the Japanese yen, and how that might be revealing a little bit about how desperate the U.S. is to make sure other countries don't sell U.S. Treasuries. But your take on that situation does this have anything to do with the strength of the U.S. dollar or the liquidity of the U.S. Treasury market?
So we've got, over the next year, we have about $8 trillion of U.S. Treasuries that are renewing. And so already the 10-year Treasury is up about 10% in, I'm going to say since it bottomed. I think it was at the beginning of March. That is huge for what most of, I'm going to say most of the world, you could almost say prices, loans, business loans, consumer credit, all these sorts of things. That is huge. And so what it also does is it wreaks havoc on the U.S. Treasury because it pushes its borrowing costs even farther up. On a $40 trillion debt and a $2 trillion annual deficit, that's a really serious problem. So, the Fed can say all it wants about how it's independent, and it doesn't look at any of the politics. It doesn't look at any of let's say Treasury issues. I don't buy it. I think that it is fully aware and fully cognizant of the restrictions and the pressures that those things create. And that, I believe, is the reason why they stepped in to help the yen to bolster it. Japan has about $1 trillion. I think it's the largest holder of U.S. Treasuries, and Japan's yen was falling. That was problematic for their economy because it started to push up the costs of imported food and energy. And as you know, it's a relatively small island with a lot of people, so it imports a lot of what it consumes. So the weaker the yen, the more these things cost. And they had one obvious option, which, as you say, was to sell treasuries. Now, selling treasuries would push Treasury yields up even further, which, as I explained at the beginning, complicates things even more for the U.S. So it's not surprising to me that the U.S. stepped in fact, sold euros, did not sell U.S. dollars to buy yen. So that was almost like it was neutralizing the potential effect on the dollar. And I think that's why we're seeing the dollar index stay relatively strong through this, because there was no pressure on the US dollar. And it helped avoid even higher Treasury yields, which, as I said, would be really problematic. So these are the kinds of things that the Fed is looking at, that Treasury, U.S. Treasury is looking at, and I believe, and I've been saying this for a while, that so I have a couple of interesting points here. One is we could see a few things happen. I've been saying for about a year that as you see long yields rise, so the 10-year, the 30-year yields rise, that, as I say, is problematic for the Treasury. It needs to pay much higher rates when it issues bonds, and so that's very problematic. It's a vicious circle when your debt is so high and you have to actually print to pay for the interest. So you're desperate at that point. You really want to keep yields down, or at least control them to some degree. So there's a tool they have called yield curve control that has only been used a couple of times since, I believe, the 40s or so. But what they would do is they would go out and buy a lot of long bonds, longer maturity bonds, and in order to keep those yields down. And so that is fine to serve their own purposes, but it's what we would call financial repression, because if an individual investor owns long-term bonds, that means that it's keeping yields low while inflation is relatively high. And so they could actually be versus the longer yields, the investor could actually be in a negative return scenario, because inflation is eating away and is higher than what they're getting on their long bond yields. So I would expect that to be something that we would see either in an overt way or in a covert way come to be over the next few quarters. I think that the U.S. will not have a choice. The other thing I find interesting is that I've also been saying that, the Fed is going to, at some point, because inflation is high and remaining high, that they're going to have to adjust at some point. And my initial thought was, now it's interesting. We've got a new Fed chair. He certainly seems to be changing things up quite a bit. I had thought before he stepped in that you'd see the Fed at some point start to switch to somewhere where, in my view, 4% is going to become the new 2% in terms of what's typical for inflation, in terms of, averages. And I thought that we would have the Fed eventually say something like, well, you know what? we really don't have a choice. Obviously, they would cloak it differently, but that you'd see their goal of 2% actually move higher to somewhere perhaps like 3%. Now, maybe that's too controversial, but what I will say is that we've got a new Fed chair. He's changing things up a lot. And during Warsh's Senate confirmation hearing, he noted that he has a preference for an inflation measurement called trimmed averages. And so really what that does is he felt that what the Fed currently uses, which is the personal consumption expenditure, which leaves out things like energy and food because they're volatile, and that helps sort of keep the reading relatively low. But he said he would prefer to use something called trimmed averages, where you drop when you measure your inflation basket with all of the different inputs, things like insurance, medical care, rent, etc., food, energy, you name it. When you put in all these factors, obviously they change every month. But if you drop, kind of like in a diving competition, right? The judge, you'll have the top score and the lower score being dropped. So they would do a similar thing here. And the argument is that inflation readings then are more fairly reflecting of the underlying, really, of economic price trends. Now, all that's fine and interesting, but if you look back at what the implications are, to me, it's not a surprise that that it turns out that trimmed averages in recent months, at least, have pointed to lower and more stable inflation numbers that are actually closer to the Fed's 2%. So wouldn't you know it, change the methodology, change your yardstick, and then you suddenly are closer to your 2% target. So you're doing your job just because of you're measuring things differently. So these are the kinds of things to look for. I just think that viewers need to be aware these kinds of things may come to pass, and we really shouldn't be fooled by it. I just think it's a more scientific way of saying official inflation is lower and we're doing a good job. Just don't buy it. Actual inflation, people feel it. We all know better. It's a lot higher than what official numbers are, and these will remain strong tailwinds for precious metals.
Now, I wanted to address a few things here. You mentioned how the Fed might be, changing its inflation. So there will be this greater real inflation, right? But they won't be reporting on it. But it does seem like, for example, with the intervention in with the yen, that the Fed has been able to avert crises, right? And we also saw a lot of people very skeptical, including myself, about that we could have a soft landing after COVID. But it did seem like there hasn't been, this major crisis that has really shook markets. I mean, we had the banking issues in 2023, but really it seems like we kind of did have a soft landing. Some people might say we had kind of a K-shaped recovery, but I guess the public perception is that, we're doing just fine. The Fed really did do a good job. So some people might be skeptical that can't they just keep doing that? I mean, do you see that things will come to a head here where they can't save the U.S. dollar, or maybe it'll be the case, as you mentioned, how the U.S. dollar will be losing value, but they just won't. They'll be kind of lying about it, right? They'll be reporting something different. What is your take on that?
So that's a good point. I mean, it's. What I will say is that, these things can go on for a long time, and then all of a sudden they can fall apart. And I think that's the more likely scenario, is kind of keep kicking the can farther and farther down the road as long as you can. And honestly, by printing money, at least for a while, you can cover up a lot of these issues. You could argue the financial crisis of 08-09 was pretty significant. Look, I remember being in meetings with fund managers, and they were saying things like, well, like this is really like this is really serious. You've got cargo ships that are floating around, not being allowed to dock at ports because there is no longer confidence in the letters of credit that the seller has been issued. He does not want that ship to dock and unload because he doesn't believe that the letter of credit he has from the buyer's bank is going to be good, is going to be honored. So you can get to these points. The way that got fixed was by some massive printing. And we know that the Fed's balance sheet went all the way up, I think it was through COVID eventually, to like $9 trillion. And then we've been, obviously, they've been trying to scale that back. The last I saw, that is in the last couple of quarters, it's starting to expand again. So you know what? Maybe we've seen the bottom of that. All that to say is that, yes, they, if things, it does seem like things have been kept sort of, I guess, from bubbling up, or perhaps from exploding. They've been bubbling, and they've kept sort of the lid on things. They've managed to keep the lid on essentially by printing, and there's always sort of I guess a wave of printing, and then a bit of a pullback, and then another wave of printing. And the problem is that each time you print and then you pull back, you're essentially never pulling back to the prior low. You're pulling back to a new higher low. And so those higher lows keep getting higher and higher. And I really think that, for what it's worth, the 1970s are a good analog. We had 3 waves of inflation. The first one was in the late 60s, and then you had mid 70s, and then you had late 70s. I think we're going to see the same kind of thing happen again this time. I do think that we're going to see, I think we've actually seen the bottom of inflation over the last few quarters, and that we're going to start to see things ramp up again. We don't have a choice. We just gave one example. The Fed stepped in, sold a bunch of euros to prop up the yen, and wants to keep the long yields down. Well, if it isn't for the yen, and there are other, let's say, pressures for them to try and keep yields down, they'll simply print. And so that can only manage for to kind of keep the lid on for so long. Printing takes a while to kind of see the effects roll out. So perhaps you're going to go 6 months, 9 months, 12 months where the effect is muted, but then eventually, perhaps a year to 18 months down the road, then you see things really start, the effects of all of that printing really start to escalate. And that's when you see the new wave start. And I think that probably we're going to see over the next perhaps 6 months or so, we're going to start to see that inflation will start to ramp up again. And, I would ask, everyone has to decide for themselves. If it is like the 1970s and we get 3 waves, you have to ask yourself which wave, or where are we, and if it does play out in a similar way. So my view is that the 9% or so peak that we saw, I think it was in 2022, July of 2022, was the first big wave. I think that we're about to embark on the second big wave. So this can go on for a while, but I think that, if it does play out like the 70s and you get 3 big waves, and that third wave is when, things get to be way too powerful, that you can't control that last wave. In the 70s, things were different in the sense that Volcker stepped in, raised rates dramatically. This could never happen again today. I'll tell you why. And I talk about this actually in my book. In the 1970s, the debt to, this is important. These things sound like just economic numbers or whatever, but I'm going to try and keep it simple, and people need to try and grasp this. The debt to GDP level, so the U.S. Outstanding debt versus the size of its economy, that's the best way I can put it, was about 35%. Today, we're at about 120%. So with the debt being so big versus the size of the economy compared to the 1970s, you have essentially zero room to raise rates in a significant way to truly kill inflation. That was the tool that was available, was used. It was painful. I remember it well. People were paying 20% interest rates on their mortgages in the early 1980s. It was wild. Like, try to imagine that happening today. Could simply not happen. So there is no ability to do that kind of thing. I think this time around, I think you need some kind of a reset, essentially. And I don't know exactly what kind of form that would take. Perhaps moving to a CBDC of some kind, so central bank digital currency, and a repricing, so to speak, of the currency. I do think that precious metals will have a role to play. I think it'll be against the will of the central planners to have precious metals have a role in backing currency, but I think it's pretty much inevitable. And honestly, I could be wrong about that. But even if it essentially does not have an official role to play, the environment is perfect for them to continue to run higher. These are hard assets that are not printable. We're talking about what's been money for 5,000 years. I can't see a better alternative, frankly, and a better hedge. So people need exposure, even if it's relatively small versus the size of the rest of their portfolios. This is an essential. I get moving on it. That's all I can say if you don't have any yet.
Fantastic. And if our viewers are interested in learning more, they can go to silverstockinvestor.com. Also on that website, they'll see the Great Silver Bull, your book you wrote. If you want to maybe leave our viewers with any last thoughts, it's been quite an exciting conversation. And as you mentioned, I mean, it's really good to hold precious metals as insurance. And it seems like throughout history, metals come back into the monetary system. We could definitely see that in the future. So last thoughts from you, Peter.
Yeah, I mean, my focus is silver. I guess I'm going to maybe repeat a little bit of what I said earlier, in the sense that silver follows gold. Gold moves first. Silver, actually, we've seen it almost without exception, outpaces gold in bull markets. So that's one thing to consider. The other thing is that, as I said, it's volatile, but you should not let that scare you away from it. In fact, I think it has a role in everyone's portfolio. I think it's a matter of degree. So if you're more conservative than average, if you're very conservative, that doesn't mean shy away from silver. That just means perhaps hold less silver than someone who has a higher risk profile. It absolutely has a role. And the mining stocks are leveraged gold and leveraged silver. So they are a way to get perhaps a higher, a more, as I say, a more leveraged return on the metals. So that's what I spend my time doing. If people are interested, certainly feel free to come and look at the website. And there's all sorts of information that you can tap into that way.
Fantastic. Peter, thank you so much for your time today, and God bless.
Elijah, always a pleasure. Thank you so much.
Right now, we're offering silver Morgan or Peace dollars in a Cull grade at one of the lowest premiums we've ever seen, and one you can't find anywhere else on the market. The silver Morgan and Peace dollars are an instantly recognizable piece of American history, and prized among collectors and stackers for that recognizability and their historical significance, as well as their strong barter value. Call us at 1-888-815-4237 for details on this rare, low-premium opportunity to stack one of the most sought-after coins in the U.S.